not there when we voted, or you might have been when we voted the minutes. I don't know that it's a big deal, but
All righty. Okay, I think I understand, Jim. With that small correction, then I think we'll ask Cheryl to correct the fire minutes to show that I arrived late and did not participate in the approval of the prior set of minutes. Do I have that correct, Jim?
I think so. I don't know that it's a big deal, Al. I'm sure nobody reads these minutes anyway. So, I mean, I'm okay with approving it as it stands.
All righty. Any other suggestions for changing the minutes? Let's just vote on approving the fire minutes. All in favor, please say yes.
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 Any opposed? Fire minutes are approved. If I could bear your indulgence to do the police minutes next. Do I have a motion to approve the police minutes?
So moved.
Okay, I see Paul is
Second.
seconding it. Any corrections to the police minutes? If not, let's vote on them. All in favor of approving them, please say aye.
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 All righty. And let's finish up with the police.
Town employees.
I'm sorry.
Okay,
Did I get them out of order? Let's do the employees. Is that it?
yep,
Okay. I see that Jim has asked to approve the minutes and Paul has seconded. Any corrections to the employee minutes? All in favor of approving them, please say aye. Aye.
Aye.
Opposed? All righty. I think we have all three sets of minutes passed now. And I see Michael is now with us and Claire. Our agenda today consists of our usual review of performance. And then our special item today has to do with asset allocation. Michael, does the asset allocation involve a vote by us today?
Yes, please.
And Jim, can I ask you how long you will be with us this morning?
I have a doctor's appointment at 9:30 in Old Saybrook, so probably 10 after 9.
Yeah.
Okay.
After 9.
Michael, is there any reason we can't do the asset allocation first before we do the performance review?
Oh, absolutely, we can.
Does anybody have any objection to moving the agenda out of order? John Brady, I know you had some concern about your personal schedule this morning. Are you okay with that?
I'm fine. Yeah, let's go ahead with it.
Okay, Michael and Claire, if we could do the asset allocation first, and then we'll move to performance review.
Absolutely. Do you have a preference with which plan you'd like to start?
Let's do
Yeah,
fire
fireman.
first.
The fireman.
Yeah.
John asked for the fireman.
Okay, so just a moment, please. Okay, can everyone see that?
Yes.
Great. So just as we've gotten a vaccine, I have finally learned how to navigate Zoom. So, but in all seriousness, good morning, all. It's great to see you all. Starting with the asset allocation, we, as you recall, back in March, we had contacted you all with kind of an off-cycle request to make some changes to the asset allocation. We had, basically raised some cash and redeployed a portion of that into the equity markets. That, with the benefit of hindsight, worked quite well. We later deployed the balance of the cash raised in March, later in the spring. The only thing we can say that could have done better there is, with the benefit of hindsight, we should have gone all in March. We more or less got the bottom right almost to the day. However, no one really expected that we were going to see the kind of recovery that in the markets that we have. But consequently, as Claire will get into later this morning, those moves certainly benefited the plan on a both an absolute and a relative basis. Now, as we are entering the end of the year, and although we are getting numbers regarding COVID that continue to get worse and worse, it does appear that we are kind of we can see a light at the end of the tunnel. We have two viable vaccines. Pfizer just announced that I think they say within days they're going to be submitting it to the FDA, and in both the Pfizer and the Moderna vaccine have shown efficacy in excess of 90%. So even if you don't believe the Russians, we have two U.S. companies as well that are showing similar efficacy. Of course, with all of that combined with the presidential election being in the rearview mirror, or at least mostly in the rearview mirror, the market is starting to prepare for when we might come out the other side of this. And part of the way that it's kind of doing that is what's commonly referred to as a rotation. And in some of the growth names, especially the larger growth names that that have really benefited from the stay-at-home environment, are I don't want to say they're out of favor, because they're still have a lot of tremendous long-term potential, but a lot of the names that have been sort of left behind, if you will, over the past number of months, we're starting to see some interest in that. And so what we're recommending essentially today is to go back towards a more neutral asset allocation, consistent with the long-term policies of the plans. So with that, I will move forward. I apologize, I can't quite figure out how to get this on full screen. So hopefully everyone can see this, but just to refresh everyone's memory, I know most, if not all of you have seen this before, but this is kind of the science behind how we look at the asset allocation. And let's start with the top left here. If we asked anyone to choose a portfolio on this graph, everyone would naturally gravitate up to the top left here, where you're getting all return with no risk. But anyone knows that's done any investing that all return with no risk is not available in the marketplace. We all know that we would never choose to be down here where we're taking all risk and getting no return. So with that as sort of a backdrop that the top left is unachievable and the bottom right, no rational investor would ever choose to be here, we have our efficient frontier, which is a set of portfolios where we essentially attempt to maximize the expected return for the amount of risk, or conversely, minimize the amount of risk for our expected return. Now, one of the little secrets about this sort of modeling is that it's done using what's called a normal distribution, or what we all refer to as the bell curve. And we know that although bell curves have a lot of benefits, we know that we don't always live in a perfectly symmetrical world, and the market tends to go up over time. However, when we have negative experience, it can have a disproportionately negative impact, the so-called left tail risk. And so what we do is something called resampling. And basically, the idea behind resampling is you often hear it referred to as Monte Carlo simulation. We basically randomize the sequence of returns and generate 1,000 different scenarios that produce the same end result, but get there in a different way. And the whole objective behind that is to compensate for the volatility drag or the tail risk or what have you, depend the black swan, pick your nomenclature of the day, but basically to try and compensate for that. And the net result of that is it slightly shifts the efficient frontier down, means we have a slightly lower expected return per unit of risk. Now, it's not to say that the top left is wrong. These are both intellectually honest. They're just different ways of looking at it. And And so it just for benefit of the board, we're going to illustrate both, but it's worth it's worth just going through that a little bit ahead of time. So if we move ahead to the next page, this shows the actual efficient frontier that we've drawn. And under the case of picture is sometimes worth 1,000 words, the triangles are 3 different portfolios. And you can see they're all kind of obscuring each other, but the dark red is the current policy. The medium orange is kind of if we just let the software drive our decision making and didn't have any human interaction, so to speak. This is where it would put you, and then this is what we're ultimately going to recommend. And then the squares are individual asset classes. So this kind of visually depicts the benefits of diversification, because you can see the individual asset classes in and of themselves, aside from the obvious that we know just inherently we want to diversify portfolios, we can see that none of the individual asset classes are really maximizing your risk return quotient. And that's why we diversify portfolios such as these. So with that, I'll pause for just a moment and open it to any questions before we get into the actual recommendation.
Yeah, Mike, the colors are kind of hard to distinguish, but the upper right square, is that emerging markets?
Yes.
Okay.
And that's interesting. Occasionally emerging markets and small cap, if you kind of extrapolate this line, it almost looks like emerging markets is right on the line there. And that gets to the, kind of the inputs versus the human portion of this. And although, if you had the tolerance for risk, there is an argument to be made that emerging markets is a nearly efficient asset class, but we certainly all know that, even if you could get comfortable with these massive amounts of risk, we know that empirically, putting all the dollars into one asset class, even though it may seem like it maximizes your return, we know that that's not prudent investing. And so that's why we kind of, dismiss this as a statistical artifact of sorts. Okay, so moving on, these are the 3 portfolios that we're going to look at today. Current target policy on the left, which is the 60-40. We're recommending staying with the 60-40. And that back in the spring, we made a tactical decision to overweight U.S. large cap, underweight developed international equity, and be relatively neutral on fixed income. And so we want to, kind of normalize that, or at least start to normalize that a little bit. We don't want to go all the way down to the long-term expectations where you see we cut large cap by 7.5 percentage points and increase international by 5.5 percentage points. But we want to go, kind of part way there. And because, one of the reasons is, of course, large cap has just done very, very well, and small cap and international have underperformed on a relative basis. But 2 is, quite frankly, with the kind of increased likelihood that we're going to get a more targeted, robust stimulus package sometime, relatively early next year, that should disproportionately benefit the smaller cap names. If you just kind of think of that, the large cap names typically have access to the capital markets. They have, capital and reserve and what have you to better help them ride out the difficult times. That's less so with small cap. But, so we feel that there are more opportunities for kind of normalization of the markets. And so consequently, our net recommendation is to move from column 1, where you currently are, over to column 3 and start to go back towards the long-term allocation by reducing the large cap exposure and slightly increasing mid cap and small cap, increasing international a little bit, and keeping our real estate and fixed income allocation as is. So that we would respectfully request a motion to approve column 3 for the fire plan.
I'll make that motion.
Can we have a second, please? I see Paul. Okay. Mike, is the proposed target policy a stepping stone to eventually moving towards the efficient frontier?
That's a great question. And I would say the answer is yes, with the caveat that this will, adjust periodically. The inputs that we use to derive this, and without, kind of derailing the conversation too much, but these are the inputs that we use to derive the efficient frontier. And these will change periodically. They're updated. We use Mercer as our capital market provider. They update these quarterly. They don't change dramatically. But if we were to rerun this, say 6 months or a year from now, it would, in all likelihood, not produce an identical portfolio. But thematically, the answer is yes. I just want to make sure that we're clear that, we can't just pull this report out a year from now and refer to it, because it will change somewhat.
Other questions for Mike?
Where are we right now, given the gains in equities versus kind of fixed income being fixed income? Where are we on the actual ratio now? Are we at 60-40? Are we?
We are a little bit overweight. I will have to get you. Candace is working on putting the rebalance sheets together right now with the with last night's value. So, and hopefully within the next 15 or 20 minutes, we'll have those updated numbers. But suffice it to say, I would state that we are somewhat overweight to equities. We did. We do have some cash on hand, and we did do some rebalancing over the summer. But with the market having run the way we are likely, just kind of based on my experience, I would guess we are about 3 to 4% overweight in equities right now.
Although, Michael, there was, I know at the end of September, there had been a contribution made, which is why the cash position was much higher across the board. And I think Candace had sent out rebalance sheets that were acted on. So I think we're closer to targets now.
Actually, I think you're right, Claire. Now that you say that, I forgot that we rebalanced after, after the summer. So, but as soon as Candace emails those over to us, we'll share those.
Yeah, I was just asking because, you wouldn't want to make any kind of abrupt move. So that looks fine.
Yeah, no, I don't think, we may be a little bit overweight here, but to Claire's point, we did do some rebalancing activity relatively recently. And that quite frankly is part of the reason why we want to be incremental here. The move we made at the beginning of the year was very beneficial. We see a light at the end of the tunnel. We see things definitely improving, but that doesn't mean we can sound the all clear bell just yet. And so we want to be somewhat incremental by going, kind of part way to column 3.
Okay.
We have a motion on the table. Are there other questions, other explanations? I don't see any hands going up. I guess I'm going to call for a vote here on accepting Michael's recommendations regarding the fine tuning of our asset allocation and moving towards his proposed target policy. So all in favor of accepting Michael's recommendation, please say aye.
Aye.
Anybody opposed, please sound off right now. I don't hear anybody objecting, so the motion carries, Michael. Thank you.
Great, thank you.
While we're at this, can we do the other 2 asset allocations for the other 2?
Yeah, absolutely. Preference for police or employees?
That's fine.
Okay, so this will be substantially similar in theme, if you will, although slightly higher allocation to the equities, 65% equities in the the town and the police pension plan. So just kind of skipping right ahead, because it's going to look virtually identical to what you've seen with the fire, at least visually. Here we are, because we have 65% in equities, essentially a lower allocation to core fixed income and slightly higher allocation to the equity asset classes. The recommendation is really the same, kind of thematically move about midway towards the long-term strategic target allocation. We'll call this kind of a modified tactical allocation. Reducing by about 10% the large cap exposure, about 0.5% on an absolute basis increase to the small and mid cap exposure, and then a bit of increase to international, and keeping the real estate and fixed income allocations as is. So unless there's particular questions, we would request a motion to adopt the proposed 65.
Michael, I have a question for you.
Sure.
There seems to be a lot of concern, at least from what I read, about real estate in terms of whether it be shopping centers, hotels, and a lot of potential bankruptcies. So you don't change any, I'm assuming in the police, it'll be the same thing.
Yeah.
Your Frontier is different on, I'm assuming, all three, and you didn't make any changes. Is there any reason for that?
Yeah, that's a great question. Quite frankly, I'm surprised it didn't come up earlier in the conversation, because it was one that we had anticipated. And it's, and it really gets down to a few things. All the points you made were absolutely spot on. The latest that we've seen in our conversations with the real estate managers is, right now there are about 1,200 regional malls within the U.S. They anticipate that number over the next several years to ultimately settle out at about 400, or a decline of about 2/3. But it is worth noting that the so-called A-rated properties continue to do quite well. It's also worth noting that, with the exception of retail, rent collections across real estate have been very solid. And if we look at kind of the underlying valuations, real estate looks more attractive than it has in a long time. Add to that, real estate is kind of a wider universe, if you will, than just buildings, or just kind of hotels and office towers and shopping centers. And it's worth noting that the demise of brick and mortar retail, or the great reduction in the use of brick and mortar retail, ultimately benefits other areas of the REIT or REIT industry. As an example, all the warehouses that Amazon has, all the server farms and data centers are all part of the real estate industry. In addition to that, cell phone towers are, and as we convert over to 5G, that will benefit that. And lastly, so is timber. And as Claire likes to say, whose husband is in the construction industry, if you need timber these days, good luck finding it. So yes, I think there's no question that traditional brick and mortar retail, and probably to a lesser extent some of the hotels, are going to continue to feel pressure, but other parts of the industry are doing well, and the prices of these investments, quite frankly, just look very, very attractive. It is worth noting that this is also precisely why we have an active strategy instead of an index in this space. The index is what, Claire, about 6% or so, I think, in shopping centers, and this portfolio is about 1/10% in shopping centers. So they have definitely taken a position similar to or consistent with what you articulated, Joe, and that they're heavily underweight the shopping centers.
Okay, thanks, Mike.
Sure.
I have a question for you with regard to this. So there are a growing number of firms that are big into residential rentals. big portfolios. I wondered, are they considered part of this class or are they looked at separately?
No, these are part of that class as well. Basically multi-unit housing. You'll also see, assisted living type facilities and senior housing, that sort of thing. What you won't see here is single family residential real estate, but anything basically for business or multi. When I say multifamily, I don't mean 2 and 3 family homes, but very apartment complexes and that sort of thing.
Any other questions for Michael?
Yeah, one more. I should know this, but are REITs ultimately priced by the value of the assets that they hold, the physical buildings, or the expected stream of rental income that they can eventually turn into dividends to the people that own them? Or is it a mix?
That's a great question, and the answer really is a mix. And when I was referring to REITs being undervalued, that's based on what they term as net asset value, or what you referred to earlier, Paul, is the kind of the underlying value of the properties. But we know the market is not always that stoic, right? And so ultimately, the market is going to move these things up and down based on a few things. One is just, sort of the perception. We know they got absolutely clobbered earlier this year. Two is the expected cash flow, but it's also the expected cash flow, not just in a vacuum, but relative to what else is available in the market. So, for instance, with treasury yields, under 1% for the 10-year treasury, and even for the 30-year treasury, that makes something like real estate very, very, or REITs very attractive. If we had 4 and 5% yields on treasuries, where people could kind of lock that in without the equity risk, that would typically weigh on the higher yielding sectors such as real estate, utilities, and the like. And that quite frankly is part of the reason we want to make the asset allocation change in general, is that we feel that with this lower for longer environment, the market's going to continue to reward risk, but thus far, at least in the past 6 to 9 months, has really not been rewarding the high dividend payers.
Thanks, Mike.
I'll make one more quick observation. Well, actually, it's not in here, but if you, we have a few minutes before Jim needs to leave. Let me just switch, go to the performance report for a second, because there's something in here that I think you'll find very interesting. Let's go to the combined report. And actually, I won't go to the performance yet, but I just want to touch on the historic numbers just a moment while this loads for me. There we go. Okay, so.
And we know we don't want to use Teams when we pull up our reports, Michael.
Yeah, actually, okay, so I am going to, just bear with me a minute while I scroll through all of this. I want to get to the police, and I'm sure the police is going to be the last in here, so my apologies.
I have the numbers in front of me if you want me to reference anything.
Well, I just want to, I'd like to show the group, if everyone will indulge me for just a moment while I get here. I think this makes a strong argument. Okay, so here we are with the police, and let's focus in, let's look at the real estate investment. And the reason I picked the police is because the timing here is particularly interesting. And if we look at your real estate here, this was invested back in 2005. So, if you kind of think back over the past 15 years, it's really been, we've seen, all sorts of perspective on real estate. We invested in things, ran up tremendously for 2.5 years or so. Then the bottom fell out, and things were, really, really terrible for real estate for a couple of years, and then it kind of has been slowly but steadily recovering, and then the bottom fell out again in March. And so, if you kind of imagine, just think back, you invested this, you had a couple of good years, you had a couple of terrible years, followed by a decade that was pretty consistently, I'll say, decent. And now we're just, starting to recover from a terrible stretch. And so even really at, this trough, if you will, going back to 2005, this asset class has averaged just under 7.4% per year. And I think, to me, that's pretty telling, showing that, there's volatility and things, and things sometimes move against it. But over time, we're not going to need less real estate, certainly. It's just, there may be a certain shift of it. But ultimately, so long as these companies can identify good properties and manage them properly, this can still be a good source of income and diversification for the portfolio.
Just sort of to echo on that point, because we've just seen such major swoops, dives, and peaks in the markets this year. And why active management has certainly been beneficial. Just, the first quarter was horrible. Second quarter started turning around for real estate. The quarter to date, so October and November, the real estate sector, just as an index, was up 6.9% just for the last month and a half. But the active managers were up nearly 10.4%. So we're definitely seeing, it definitely, was kicked when it was down, but this market is definitely not dead. There's, as Michael was mentioning, there are a lot of very strong pockets within real estate as a whole.
I don't know. I've been nervous about REITs during the early part of the year, but it seems to me that these are giant companies with huge amounts of assets. They don't want to hold a bunch of cash. Now they're chasing not a few, but a defined group of valuable properties. With everybody chasing them, I think they will chase the price up. Thus my question on how they're evaluated, by the value of the properties versus the value of the income stream, because I don't think the income stream is going to change much, but the values of the properties, with supply and demand pushing down the number of valuable properties, should make them go up. But I don't know. That's just all.
It's also worth noting that the REITs in general, the companies, are financially in pretty good shape. They've really kind of righted their balance sheets, and we've sort of seen this. Simon Properties is a perfect example. And we've seen some high-profile retail bankruptcies, Brooks Brothers being one of them, and Aeropostale was being another one. And Simon Properties put together consortiums basically to come in and bid on these companies. Not, because they're their tenants, but also because they feel that there's potentially some value, and quite frankly, they have the balance sheet to do it. So yes, it can be a volatile asset class, but it does provide risk return diversification. And I think I just moved on to this page as well, because it kind of shows you over time, a few extra basis points from the active management makes a difference in total return. And if we kind of focus in the benchmark, this over this past 15 years that you've had them is returned 6.51%. The portfolio has returned 7.38%. But look at what that means in terms of total return. Going back 15 years, what difference a few basis points makes. 161% total return for the index versus 196% total return for the benchmark. Or excuse me, for the portfolio. I know we kind of got off topic a little bit, but I think it was a good question.
Alrighty, I think we're, I just want to keep us on track here. I think we were getting ready to vote on the fine tuning of the asset allocation for the town employees. Is that correct? We had a motion and a second. Jim, are you trying to speak? You're on mute.
My comment was simply that that's a good point, the active management versus just doing an index in this class.
Alrighty, any other questions about the asset allocation that Michael has proposed for the town employees? If not, I'd like to call for a vote. All in favor of accepting Michael's recommendations, please indicate by saying aye.
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 Any opposed? Hearing none, the motion is approved. Thank you. And I think we have one more asset allocations. Is that correct? We haven't
We have
done.
one more, and this is, virtually identical to the, what you just saw for the town. So in the interest of time, I will skip ahead as soon as this loads for me. And again, our recommendation is to adopt the proposed 65-35 column, which you'll notice is the same asset allocation as the as was proposed or just recently approved for the town plan.
So if that's the case, if it's okay with Al, I'd like to make a motion that we approve this.
Second? I will second it. Any further discussion on accepting Michael's recommendations for the police? If not, let's vote on it. All in favor, please say aye.
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 Any opposed? Hearing none, the motion carries. Thank you, Michael.
Welcome.
I think then we will move back to performance review, and I would like to do the fire department first.
Okay. Whoop, sorry, I just hit the wrong button. Okay, so let's start. We'll do the combined report, because I know fire is first.
Pulling us up to the page, if we can go to page 7, Michael, for the 30,000 foot view. I was talking earlier about how we've had such a volatile year for performance, and as Michael alluded to earlier, parts of the market have been incredibly strong. Large cap growth has just been dominant this year, and that has a lot to do with the technology companies and those that are for security, for having our Zoom meetings, our WebEx meetings, e-commerce. So that certainly, a lot of this has been driving the market, but we did see a rotation. So year to date through yesterday, large cap growth was up 30%. In fact, all the growth, large, mid and small, were strong. Mid was up 24, small cap growth was up 19. And that compares to the value side, which is pretty much in negative territory, although reasonably small. But small cap value has had a tough year, now nearly 4%. But if we look at just into our what we have of the fourth quarter so far, we definitely we're starting to see a rotation. And Michael was talking about the fact that we might see, smaller companies doing better and value also doing better. So we actually saw for the last month and a half, small cap value was the strongest part of the market, probably because it had been oversold, and it's up nearly 23%. And large cap growth up 5%. So definitely beginning to see a rotation there. And we see that come through in some of the returns that were available for our managers. But looking at our performance here, so we're doing our long-term view and our return since inception, we're up, you have to squint, just over 6%. Going back, we've about 6.5 years, and that compares, had we indexed everything, we would have been up about 5.6%. So we do see some outperformance there. If we look at the beta, that's the volatility. Our market index has a beta of 1. So we're sort of in line. So achieving that slight bit of outperformance, we did it with 1% more risk. So pretty similar. Then what sort of comes through a little bit here is on our upside and downside deviation. So when we look at on the upside, when capturing the positive parts of the market, we're just a wee bit ahead. So when in positive territory, we've really captured all that upside. And then when we look on the downside, there's been a little bit of protection. That you see the number is 7.7% compared to 7.9. So some protection on the downside. So that's sort of the way you would like to see the numbers. And this all comes together in the alpha. And the alpha says for the amount of risk or volatility in achieving that return since inception, there's an expectation of return. So the more risk you take, you better give me a reward for taking that risk. It's why equities have more volatility, but historically they've had a higher return than that achieved in the fixed income market. So taking the risk has been worth it. And so anything in positive territory is added value. Now, I realize that 0.04 is a pretty small number, but the alpha always tends to be small. If you see a 1% alpha, that's pretty darn good. So we're on the right side of the track. It says value has been added, the return was above that was expected. So good news there. And then we track down to our cash flow. We started off with $0. And I think we mentioned every time there's a contribution and we do this rebalancing, the contributions and withdrawals are also purchases and sales. So these numbers get bulked up. So ignore those numbers, and what we focus on is the net cash flow. So since inception, just over $1 million has come into the Fireman's benefit plan. We've also seen growth to the tune of about just over $500,000 from realized and unrealized gains, plus interest and income. So we closed the third quarter with $1.6 million. Now, since the end of September, the markets have been very strong with a couple of sell-off days. There was net withdrawals of about 11,000, but we closed as of yesterday. The plan had risen by about another $90,000. So the valuation was $1,688,760. So we got a wee bit of an increase since the end of September. Okay, so let's look back to the underlying portfolios. Okie dokie. I should have brought my glasses. So the good news is we have outperformance across the board. So for the short time frames right through to inception, we have outperformance. And I think certainly we did see some benefit from, Michael was talking about the tactical allocation that was made earlier in the year when we took some profits off the table from the fixed income markets. And then put them to work when the market was on sale. So that definitely has been beneficial. And also we got the benefit from adding in, you can see the Fidelity Large Cap Growth Index, there's about 12% there. So that was the strongest returning class in the third quarter. So we got a nice little boost from that investment too. So coming together, we see that for the third quarter, we were up 5.7%. Compared to 5% for the index. Year to date, up 2.2 versus 0.6% for the index. And that outperformance, carries through the 1 year number. So we're in positive territory now. We've made up for those dreadful negative returns from the first quarter. So up 7.7 versus 5.8. And then that tracks along. You can see the 3 year and 5 year numbers. We're up 5.9% for 3 years and 7.3%. So strong returns there. We are indexing a goodly portion here. We have about 21% of the portfolio is being indexed. So obviously there's some solid returns from the index funds and obviously at low rates of return, at low rates of cost. So we move into the international portfolios where we start our active management. We have Transamerica and Lazard, and we have two complementary managers here. Transamerica is on the value side, and EFI has sort of more of a growth tilt. And you see, even as with the domestic markets, we saw a noticeable spread in returns from the EFI, which for the year to date was a negative 7%, compared to the EFI value index, which was negative 18. So, a noticeable spread as we saw in our own domestic markets. The same was true internationally. So we have both of the managers outperforming, although we're taking some cold comfort here as, year to date, you can see we're still on negative numbers. But Transamerica, obviously, as I said, cold comfort, they were down year to date 9%, but had that been indexed, that was down a negative 18%. So, a decent spread of conservation, if you like. And Lazard also doing better than the underlying index. When we look at Invesco developing markets, this used to be the Oppenheimer Fund, they just renamed it recently. They took a little bit of a breather in the third quarter, although strong positive numbers there, emerging markets did turn around nicely. Part of the reason that Invesco underperformed is they are underweight in China, South Korea, and Taiwan. They especially consider Taiwan and South Korea as really more developed markets, and they're very light in them. Because of COVID and those three countries clamped down very hard on stopping the movement of people, their economies turned around faster. And so that underweight did hurt them. But longer term, we're seeing that solid outperformance. Cohen & Steers, we're into our real estate territory. Again, they're outperforming across the board. The third quarter number is a little misleading. You may recall in the second quarter, the return was short of the index. They posted a capital gain and dividend right at the very end of June. And because of that, it didn't get picked up on the statements. And so the number was short and we get that boost in the third quarter return. So the fund was up over 3%, so it was still ahead. But now that we've sort of captured the gains and the dividend. And so again, Cohen & Steers have really done a solid job in this market. They've sort of had some benefit from, they've been historically underweight in the office area. They've been overweight in data centers, also overweight in the industrial and self-storage. Industrial has been one of the really strong areas because it encapsulates the fulfillment centers. Amazon apparently are going to be upping their spending by about 50% because their sales are just going through the roof. Cold storage has been really huge because so many people now are buying Fresh Choice or there's other online food delivery, and they need to prepare and store that food before it can get sent out. So that's been an area where we've seen a lot of growth in demand. Self-storage, as people are have been moving out of the cities into the suburbs, or the students have been coming home, self-storage has become a much more growing area. Also in the South, many houses in the South apparently don't have basements. And so, which we didn't realize until we had a conference call with Cohen & Steers recently. And so self-storage in some of the southern states has actually been a growing area too. Turning over to our fixed income managers, we have BlackRock. And so the reason that we have, obviously it's a 5% allocation. So the bulk of the money here is with Voya, and Voya is sort of a high quality, investment grade only domestic portfolio. And so with the BlackRock, what we're looking to do is to capture some of that higher return that's available from the high yield market. Obviously there's more volatility incorporated into the high yield, but as we go back to inception, or the 5-year inception, it has been an area that has garnered a higher return. And BlackRock has got a very deep bench of analysts. They're also very actively managed. It's a very diversified portfolio. They have recently had a higher allocation to the junkier area. They have about 14% in CCC. And now why that was beneficial to them in the second and third quarter, it did cost them in the first quarter, which is why we see that underperformance. And then, as I mentioned, Voya is our high quality manager. They did take the opportunity in the first quarter to increase their corporate security because a lot of those positions were undersold. So they are overweight in corporates, and their duration, that's where the duration is also just very slightly over that of the benchmark. So that has been, with interest rates being so low, that slightly longer duration has been beneficial. Michael, I don't know if you have anything to add on firemen's.
No, I just wanted to point out, so I don't delay things. We did receive the updated allocations and values while Claire was talking, and she referenced them. But I did want to point out, in particular, the international on the and the real estate, quite frankly, on the fire plan. All three are up about 10% since the end of the quarter. So certainly moving in the right direction. I'll forward these on to Cheryl after the meeting, but just in the interest of time and bouncing back and forth between documents, unless folks really want to see them right now, it might be easier to just refer to them and forward them on for your review afterwards.
Michael and/or Claire, what does the market think is going to happen next in terms of U.S. government policy towards dealing with the COVID crisis, the financial aspects of the COVID crisis?
Well, I think it's, we obviously still have a, sort of a bit of a food fight going on Capitol Hill with regards to that. If we look back to the spring, we were very pleasantly surprised by the reaction of both our elected officials as well as the Federal Reserve, who really, kind of learned a lot from 2008, and that is, basically they didn't wait for something to go wrong. They really kind of threw everything at it. Subsequent to that, the Fed has continued to really do an excellent job, and has been a tremendous source of confidence for the market. Less so the legislature, and we'll spare you the headlines that everyone's seen. But that being said, there is some bipartisan support for some sort of stimulus package. There's also some bipartisan support for an infrastructure build, and so we're hopeful and confident that into the beginning of the first of the year, probably after January 20th, but early into the first of the year, that we will see more targeted fiscal support. We don't anticipate payments being, quite as broad as they were at the beginning, but there's certainly, now we're kind of living with the so-called 90% economy, if you will, where a lot of folks are, the social aspects notwithstanding, from a work point of view, a lot of folks are able to adapt, but there's still this portion of the economy, particularly travel, leisure, and the like, that is suffering and is going to continue to suffer for the foreseeable future. And so we anticipate it being more targeted, but that something will come in the first half of the year. And one thing that I think we can all be very confident of is that the Fed will continue to be very, very accommodative. The Fed has really said in no uncertain terms that they're going to keep rates lower for longer. And they did this, in typical Fed speak code. But when they said that they were shifting their inflation target from a 2% target to a 2% average, just the inclusion of that word average was a significant difference, because we know that we haven't been able to get 2% inflation consistently for a long, long time. And so adding the word average in there is basically the Fed's way of saying, we're going to let the economy run hot for a while. We're not, just if we hit 2% inflation with any consistency, that doesn't mean we're going to raise rates. So long story short, the Fed's going to continue to be accommodative, and we're optimistic that the legislature will come up with another fiscal package into the first half of the year.
Thank you. Any other questions for Michael and Claire?
Yeah, Michael, I have a question for that. You mentioned, if Congress passes more stimulus bills, then somebody's going to pay for that eventually. But what about the Fed policy? That's another thing who's paying for that eventually?
Yeah, I mean, it's a great question, and it's right now it's the our debt and our deficit are not problematic at current levels, and this has been an ongoing theme really for quite a while. The issue or the concern is that there doesn't seem to be a whole lot of political will on either side of the aisle to develop a long-term plan to deal with it. It is worth noting that who benefits most from low rates, but the biggest borrower in all the world, and that's the Federal Reserve. And if you actually look at interest payments in terms of dollars, because rates are so low, our interest burden is monetarily consistent with what it was back in the early 1990s. So if rates go up, if rates go up, they don't even really need to go up that much for it to be problematic. But right now, it's really sort of a wartime footing of sorts, where it's it's not a question of whether we spend the money; it's a question of how we spend the money, because and I think to their credit, the Fed in particular. And earlier on, the Congress has kind of adopted that view, because if they didn't do that, ultimately the cost to the economy would in all likelihood have been far greater than what it was. But you're absolutely correct. On one hand, we can't continue to borrow indefinitely, although the modern monetary theorists would say otherwise. But I think in general, this is going to continue to be a topic. It'll probably continue to get kicked down the road, and in so long as the U.S. government is able to borrow in its own currency at very, very low rates and continues to be sort of the gold standard around the world, and the economy continues to grow. It doesn't, as of now, appear to be a significant problem, but it's something that's going to need to continue to be monitored for sure.
Thank you.
The savings rate has been abnormally high because people with money haven't been able to get out and spend it. What's your feeling there? I mean, do people get a vaccine and head to the Louis Vuitton store and go buy a car and some sort of burst of spending that would affect the market?
There definitely has been increased spending just in the homes. I talked to so many friends and just people I know, and they're remodeling their bathrooms and redoing their kitchen. Mike mentioned my husband's a contractor, so people doing roofs, windows, and siding. There's been a notable increase. So definitely has been spending. Some of it's just been in different areas. One of the other areas, talking about real estate, where there's been an increase is casinos. But they were sort of one of the better performing sectors, because people were able to, at some point, to be able to get out. They went out and they spent money. Now that's going to be obviously be reined back in again for the next few months, but. Some of the hotels actually have seen better business too, as people have got out of the cities and they wanted to be in areas where there's not such a high concentration. So money is definitely being saved more, but people are finding ways to spend it as well. But to your point, for sure, I think when we get the vaccine and the economy sort of starts to get back on its feet, people are going to be wanting to go out and go to restaurants and go to movies and go to the stores. So I think there's definitely pent up demand that we'll see an outlook for next year.
And add to that, I know Joe Mako and I have discussed this numerous times over the years, but I don't know if you saw the news this morning, but the FAA gave the 737 MAX the go ahead, and certainly, obviously, because of COVID and in the grounding, there've been a fair amount of cancellations and what have you, but there is a lot of pent up demand. People are not saying, I'm not traveling because I don't want to. They're saying, I can't wait till I can feel safe and get out and travel again.
Michael,
a-
do you have any recommendations regarding this portfolio?
Other than the asset allocation change, no, we're comfortable with the investment lineup. We think it strikes a good balance between active and passive to, we can see the active managers have been able to add value, but, the inclusion of some passive has kept the cost reasonable. And as Claire discussed, certain asset classes obviously better than others, but the overall on both an absolute and a relative basis, the performance has been kind of consistent with our expectations. And really, if we kind of look at the lens of what we were all thinking when we met during the spring, I think everyone's surprised at just how well things have improved since for the equity markets, or for the capital markets, should I say.
Al, can I ask a question or two?
Absolutely, Fillmore.
Okay, a little bit different, but Claire, a few minutes ago, you gave us a snapshot of what I believe the fireman total value was as of last night. I wondered if you had similar numbers for the police and town employees.
I have employee info. I just sent a note to Candace saying I'm still waiting on police. So we have an update on, and I'm sure I'll have police in just a moment. Employees, we finished the third quarter with $22.6 million. Since September, there was net withdrawals of 134,000. We've actually gained $1.3 million since September. So we closed yesterday with the employee pension plan had a value of $23,793,515.
Okay, thank you.
And
my email just kicked in. Let's see. Oh.
so, and Fillmore, just trying to get to the page here, but oh, goodness.
While you're doing that, Michael, so there were no acronyms for this?
There is an acronym for this quarter. I think we went out of order a little bit. So, but real briefly, I know you need to leave in a few moments, Jim. So since if it pleases the group, I'm happy to go through it. The acronym is SCIRT, and the S is for science. I think, we've certainly all been inundated with all sorts of news and opinions masquerading as news. But as kind of we're learning, as we're nearing at least the to paraphrase Churchill, the beginning of the end, that science does matter.
It was the end of the beginning.
Well, right. So I'm kind of paraphrasing, saying we're at the beginning of the end. In that, in March we weren't at the end of the beginning, but now that we have a vaccine, we're assuming we're at the beginning of the end.
Okay.
But so that the S is for science. Here's the values, just so you can compare to what Claire said. The K in SCIRT is for the K-shaped recovery. We've heard a lot of talk about what form the recovery is going to take. Is it going to be a U, a V, a Nike swoosh, an L? And ultimately, it looks like it's going to be a K, or I would actually say in some ways, maybe a C is more appropriate, in that we have seen, if you're in the kind of the right part of the economy, then you've seen a sharp and relatively quick recovery and haven't been negatively impacted financially too greatly. However, if you're in certain parts of the economy, particularly the lower paid, lower skilled folks, that is going to continue to struggle. And that's sort of the idea with the K. You get this this up and down look. The reason I said it's sort of a C is because at some point we're going to see the trough and kind of curve for the folks that are at the bottom, and we're going to see a bit of a plateau for the folks that have recovered. But regardless, that in some way, shape, or form, that's the way that it's moving. Inflation we already talked about in the context of the Fed, but yes, there is a lot of talk that all the expansion of the monetary system in the money supply will be inflationary. We don't, that may be an intermediate problem, but it's certainly not a short-term problem. Right now, we need to make sure we keep the economy well greased, if you will. And we talked about how the Fed has kind of changed its stance on its inflation target. The R is for rates. We also discussed that already, but rates we anticipate going to stay lower for longer. We don't anticipate, based on what the Fed has said and based on the overall conditions, that we're going to see negative rates in the U.S. But quite frankly, we said the same thing about some of the European countries too, and they've persisted there. So stay tuned for that. But we do anticipate rates will be lower for longer. And then lastly, the T is for taxes. Without keeping this as apolitical a discussion as possible, we think that unless there's a significant shift, if you will, in that the runoff elections in Georgia both go to the Democrats, and even if that happens, quite frankly, we don't anticipate significant changes in tax policies owing to the election. In addition, not only did the Democrats lose a number of seats in the House, and it looks like the Republicans are going to retain the Senate, but even if they don't, it's kind of close enough so that it's unlikely that we'll really be able to push through broad sweeping changes. So taxes will probably start to cycle up, but that will more come in the form of letting tax cuts expire, as opposed to what we think are going to be really affirmative and in some cases almost punitive tax increases.
Thank you, Michael. I'm glad. Thank you for doing that. I do have to jump off. So thank you. Good to see everyone. Let's hope things continue like they have in the past few months.
Absolutely.
Okay.
So, fingers crossed, happy holidays, and hopefully we'll see you in the new year in person.
Thank you.